All right, everyone, welcome. I know many of you are here for your business administration major, and you see accounting on your course list, and let's be honest, you might feel a little nervous. You're probably picturing some really complex math or just endless, boring spreadsheets. Well, I'm going to ask you to just for today, push that idea completely out of your mind. We are not going to treat accounting like it's math. We're going to treat it as what it actually is, the universal and absolutely essential language of business.
So let's just start with this one big question. I want you to think about any company out there. Could be the coffee shop down the street, could be Apple. How does a business like that tell people what's going on inside? How does it communicate its health, its history, its strategy for the future? How does it tell its financial story?
Well, the answer is it speaks a language. And just like English or Spanish, it has its own vocabulary, its own grammar, and its own rules that let it communicate some incredibly complex ideas with absolute precision. So our goal here isn't to just memorize a bunch of terms for an exam. No, the goal is to become fluent, to be able to speak and read this language. Because that fluency, that's what's going to separate you from just being a participant in the world of business to being a true leader.
Okay, so let's dive right in. When you learn any new language, you have to start with the basics, right? The fundamental structure, the grammar. Well, in accounting, our most basic grammatical tool is something called the T account. Now, it might look almost ridiculously simple, but I promise you, it is the bedrock of the entire global financial system.
And here it is. Seriously, the T account is literally just a big letter T that you draw on a piece of paper. The name of the account, something like cash or sales revenue, goes right on top. And that T shape perfectly creates two sides, a left side and a right side. That's it. But here's the amazing part. Every single financial event you can imagine, from a company buying a rival for billions of dollars to just buying a pack of pens for the office, can be broken down and perfectly understood using a series of these simple little T accounts. It really is the atom of financial recording.
So now that we have our tool, we need to learn the rules for how to use it. And I want to be very clear. These are not just suggestions. These are the unbreakable laws of accounting logic. We call them the rules of debit and credit. And getting these down is absolutely non-negotiable for anyone who's serious about a career in business.
First up, let's talk about the left side. The left side of any T account is always the debit side. You'll often see it abbreviated as DR. Now, that comes from the Latin word debere, which means to owe. But for our purposes, I want you to burn this into your brain. Debit equals left side. That is its permanent address. And depending on the type of account, a debit can either increase it or decrease it.
And you guessed it, here's its counterpart. The right side of any T account is the credit side. We abbreviate that as CR. That word comes from the Latin credere, which means to trust. But again, the most critical piece of information for you right now is this. Credit equals right side. And a credit entry will always have the exact opposite effect of a debit. It increases things like liabilities and revenue and decreases others.
Okay, now this slide right here is where it all comes together. This table lays out the entire logic of the system, and it's all based on the fundamental accounting equation, which I hope you remember, assets equals liabilities plus equity. That equation must always be in balance. Let's look at how these debit and credit rolls make that happen. Let's go through it slowly. Look at assets. These are things the company owns, like cash, buildings, equipment. They're on the left side of our big equation. So to increase an asset, you debit it. You make an entry on the left side. Makes sense, right? Now look at the other side of the equation. Liabilities. That's what the company owes, like a bank loan. And equity. That's the owner's stake in the company. To increase either a liability or an equity account, you credit it. You make an entry on the right side. Do you see the beauty of that? To increase the left side of the equation, we use a debit. To increase the right side, we use a credit. It is a perfectly symmetrical, self-balancing system. Now what about expenses and revenue? Well, they're temporary accounts that eventually roll up into equity. Think about it. An expense like paying salaries reduces the company's value, right? It reduces equity. So to show that, we increase the expense account with a debit. On the flip side, revenue from selling our products increases the company's value. To show that, we increase revenue with a credit, which ultimately increases equity. The most important thing to take away is this. Debit and credit are not good and bad. They are just directions. Left or right, that's all they are.
So, we've gone over the theory, we've gone over the rules, and honestly, that's the easy part. The real learning, the part where you actually become fluent, comes from applying this grammar to what happens in the real world. So let's move on and actually watch how these rules build a financial story.
Okay, so we're going to start our own little hypothetical business, something I think you can all relate to. Let's imagine we've just launched a company that makes custom-printed t-shirts and hoodies for all the student clubs and events on campus. Right now, we've got nothing. No cash, no equipment, just a great idea. So let's start recording our very first financial activity.
First things first, we need some startup money. We need capital. So we head to the bank, we make our pitch, and we successfully get a small business loan for $5,000. This is it, our very first economic event. So the question is, how do we tell this story using the language of accounting?
Okay, let's analyze this. What did our company get? We got $5,000 in cash. And what is cash? It's an asset. According to our rules, to increase an asset, we debit it. So boom, we make a $5,000 debit entry on the left side of our cash T account. But remember, that's only half the story. Every transaction has two sides. So where did that cash come from? It came from a loan. A loan is a liability. It's something we have to pay back. And to increase a liability, we credit it. So we make a $5,000 credit entry on the right side of our loan payable T account. Look at that, it's perfect. This is the core principle of double entry accounting in action. Debits always equal credits. 5,000 on the left, 5,000 on the right. The system is in perfect balance. All right, so now we have cash, which is great, but cash just sitting there doesn't actually make any t-shirts. We need the machinery to do that. So we take some of that cash and we go out and buy a high-quality printing press for $1,000. Let's go ahead and record this second transaction.
So let's break it down again. What did the company get? We got a piece of equipment. Equipment is an asset. So to increase an asset, we debit it. We'll make a $1,000 debit entry in a new T account called equipment. Now, what did the company give up to get that machine? We gave up cash, and cash, as we know, is also an asset. So to decrease an asset, we credit it. That means we'll make a $1,000 credit entry in our cash T account. Now pay close attention to what just happened here. This was an asset exchange. We're not richer, we're not poor, we simply transformed one asset, cash, into another, more productive asset, equipment. And once again, what do we see? Our debits of $1,000 equal our credits of $1,000. The system remains perfectly in balance.
So we've made a couple of entries in our T accounts. And right now, this might just feel like tedious record keeping. But this is the moment where everything pivots. For you, as future managers and business leaders, the recording part is just the beginning. The real skill is learning how to read the story that these numbers are telling, and then using that story to make smart, strategic decisions.
So let's do that. Let's take off our bookkeeper hat and put on our CEO hat. I'm looking at these two transactions we just put into our T accounts. What are they telling me about my brand new company? What's the narrative that's starting to form here?
You know, looking at this, I don't just see numbers on a page. I see our strategy taking shape. That second transaction, that's the critical one. It shows we made a very deliberate choice. We didn't spend that $1,000 on a fancy launch party. No, we converted a non-productive asset, cash just sitting in a bank account, into a productive asset, a machine that's going to be the engine of all our future revenue. So this transaction isn't just an entry, it is the physical evidence of our business model. Our entire investment strategy is laid bare right here in the numbers, for anyone who knows the language to read.
This right here is the value chain of accounting information. This is the whole point. We start with the raw data, those individual business transactions, and we record them using the grammar of debits and credits in our T accounts. Then, at the end of a period, we summarize all those T accounts into formal financial statements. For instance, the final balances in our asset, liability, and equity T accounts all get summarized onto the balance sheet. That gives us a perfect snapshot of the company's financial health on a specific day. Then, the balances in our revenue and expense accounts get summarized onto the income statement, which tells the story of how profitable we were over a period of time. But the process does not stop there. The final and most important step is to analyze those statements to make intelligent, informed, strategic decisions about the future. That is the entire purpose of this whole process. Now, as you start to use these concepts in your homework, on exams, and eventually out in the real world, you're going to run into some common stumbling blocks. Everyone does. So let's wrap up by focusing on these so you can start to build confidence and really develop that sharp, critical eye of a financial analyst.
These are the classic mistakes we see all the time. The first one is really just a matter of practice, drilling those rules from the table we looked at until they become second nature. The second and third points are all about discipline, always remembering the double entry system and checking that your equation balances. But I really want to focus on that last point. In your everyday life, when your bank account gets a credit, that's great news. It means you have more money. You have to actively unlearn that definition in this classroom. In accounting, credit simply means right side. That's it.
A credit to your sales revenue account is fantastic. A credit to your cash account means you have less cash. The word itself is neutral. Its meaning depends entirely on the context of the account it's in. Please, do not assign a value judgment to the words debit or credit.
I want to leave you with this final thought. These principles we've covered today, the T account, debits, credits, the dual entry system, I know they can seem a bit technical. But mastering them is not about getting an A in this class. It's about acquiring a fundamental power. It's the power to look at any organization, in any industry, anywhere in the world, and truly understand its health, its operations, and its strategy. It's the power to make informed decisions. And that, ultimately, is the power to lead.
So, as you go forward from here, I want you to try and see every financial report you come across not as just a boring page of numbers, but as a story that's waiting to be told. You now have the foundational grammar to start reading those stories. The only question left is, what are you going to discover?